Since my last video about Alibaba, some of you requested for a BIDU analysis. And here we go, let's talk about BIDU today. But I do apologize for the delay post. In this video, I'm going to walk you through the company's business model and we're going to have a closer look at the financial statements. You see, I've got my laptop here, so I'm going to share my screen when I do the analysis. And of course, we're going to see the intrinsic value versus the current market stock price to see if you have enough margin of safety to invest. And at the end, I'm going to talk about the risks and concerns to invest in BIDU. Hi, my name is Irene. I create contents about investment, personal finance, and financial independence on my channel. So subscribe if you're interested in any of these topics. And I'm not a financial advisor, so my opinions about BIDU should inform your decision to buy or sell this stock. Please do your own research and consider your own risk tolerance before investing. Now, are you ready for the jam-packed BIDU analysis? Let's go. When we analyze a company, what we want to find out is the company's business model and how does it generate profits. Is it because of its wide moat to be able to charge a decently higher price, or is it because of its dominant market share, or both? And we also want to know how does the management convert these profits into cash flow, and how efficiently do they operate the business to move the company forward. Whether it can make good use of the debt and equity to generate more profits and return back to the shareholders with sustainable dividend and continuous earning growth. Of course, in our case, BIDU doesn't pay any dividend, but we can grasp most of this information by looking at the company's financial statements, not the market price movement. I'm going to spend a couple minutes to have a deeper understanding of BIDU's business. If you already know it, feel free to skip the chapter. BIDU was established as a search engine in 2000, 1 year after Alibaba, 2 years after Google and PayPal were founded. Its search engine is currently the 5th largest website in the Alexa internet ranking, after Google, YouTube, Tmall. I have to mention that the co-founder, chairman, and CEO of BIDU, unlike the founder of Alibaba, Jack Ma, who didn't know much about computer and internet, Robin Li actually studied information management in Beijing University. By the way, this is one of the top 2 universities in China. And he received a master's degree in computer science in University of Buffalo. He created Randex, a site-scoring algorithm for search engine page ranking in 1996, which has a very similar algorithm filed by Google 2 years later. Of course, Robin Li used his Randex technology for the BIDU search engine later on. So as a current CEO of BIDU, Robin Li definitely has more knowledge in the field, and therefore he should be more hands-on in leading the company. Over the 20 years, BIDU has built a diversified portfolio of products and services. It's not only a Chinese search engine anymore. Rather, the company likes to claim itself as a leading AI company with strong internet foundation. Its business is composed of 2 parts. The first part is the BIDU Core, which generates over 70% of the revenue. The second part is the iQIYI, which is an online entertainment content sharing platform. By June 2021, iQIYI subscribers reached 106.2 million, which is about 7.3% of the Chinese population. iQIYI went public on the NASDAQ Global Select Market under the symbol IQ in 2018. Let's have a look at the BIDU core business. BIDU's mobile ecosystem is its foundation products it started with, but its AI cloud and intelligent driving, even EV, electric vehicles, have been growing and have great potential to generate more earnings. Based on the second quarter financial result released on the 12th of August, BIDU core revenue grew 27% year over year, boosted by AI cloud growing 71% year over year. According to the data from Canalys, cloud infrastructure service spend in China grew by $2.1 billion or 55% year over year in the first quarter of 2021. And China was the second largest cloud infrastructure services market after the US, accounting for 14% global investment. Within China, the top 4 cloud service providers in China were Alibaba Cloud, taking about 40% of the market share, Huawei Cloud 20%, Tencent Cloud 14%, and BIDU AI Cloud 7%. Within the intelligent driving and other growth initiatives, there are 3 parts. One is the Apollo ecosystem, Apollo Robotaxi, and intelligent EVs. And let's look at the Apollo Robotaxi. It received T4 license, which is the highest level of autonomous driving test license. Although robotaxi is in the early stage with limited revenue contribution, but it represents a huge opportunity. And now let's look at the intelligent EVs. BIDU recently formed a new EV company and have entered a strategic partnership with the auto manufacturer Geely. This is the company that bought the Swedish Volvo cars in 2010. If we look at the EV sales in China, by looking at the top 20 plug-in vehicles in China from January to November 2020, by the way, the brands in bold are fully electric. And so we can see some famous Chinese EV makers like NIO, Xiaopeng, Li Auto. Analysts at Deutsche Bank forecast that sales of EV in China are likely to double this year. No wonder some tech companies that are so eager to enter this fat EV market. We can see Alibaba and SAIC Motor, they are partnering up to produce electric cars, and Didi and BIDU, they co-develop a model for ride-hailing. So far, I think we've done a pretty good job in examining Baidu's business that it started as a search engine, and we can see it aggressively expanding its business portfolio by having AI cloud, intelligent driving, and even EV market, which has a lot of opportunities to grow its revenue. And this step is very important because we don't want to invest in a lousy company only because of its share price keeps going up.
If you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
Now I'm going to share my screen and let's look at the three financial statements, and starting with the profitability, the income statement, by using the Seeking Alpha data. Starting from the revenue, we can see the revenue reduced slightly by 0.51% year over year by December 2020, but good to see the trailing 12 months has increased 19.45%. By comparing Q2 2021 to Q2 2020, the total revenue has grown by 20%. Let's look at the bottom, the net income for the fiscal year 2020, which is about 21%. From the second quarter report, the net income has increased by 5% year-over-year basis. In general, since 2011, the total revenue is in an upward trend, and we can tell from the gross profit margin that Baidu is putting less margin on its products and services over the years from 73% to 50%. However, its bottom net income fluctuates a lot by different factors. From its Q2 report, Baidu has provided some notes of the increasing costs, such as the cost of revenue increased 21% because of the increase in traffic acquisition costs. For tech companies like Baidu, the research and development expenses can eat up a big portion of the revenue because they need to hire the right people and invest in the right equipment to do research. Now, let's have a look at how its peers are doing. I selected a couple of companies in the same communication service sector with similar market cap and enterprise value. They are Twitter, Match, Weibo, and Snap. I didn't include Facebook or Google because they both are too much bigger than Baidu. Let's see, Baidu's year-over-year revenue growth is the lowest, and its net income margin is the best among the 5 companies. Its return on equity is outstanding as well. However, the bigger gap with its return on assets means that its total liability is not a small number. In Baidu's 2021 second quarter report, Baidu expects the third quarter revenue to be between 4.7 to 5.2 billion, representing a growth rate of 8% to 19% year-over-year. Profits are good, but we need the cold hard cash to keep the company up and running. Show me the money, because we need to pay the suppliers, we need to pay for the research, we need to pay for the employees, and we need to pay for the creditors. And we can get the details about how does the management turn these accounting earnings into cash flows from the cash flow statements. And there are 3 major sources of cash flows: from operating, investing, and financing activities. And for value investor, we want to see the majority of the cash flows are generated by the CFO, the operating activities. And ideally, we want to see the CFO is higher than net income. Let's look at Baidu's number. Yes, the CFO has been constantly higher than its net income every year. from financing cash flows, it's good to see Baidu has been repurchasing its stocks. And in 2020, they bought back almost $2 billion US stocks, which indicate that Baidu's management believes their shares have been undervalued, and this buyback normally would boost the share price, so it is a good signal for investors. And lastly, we want to have a look at Baidu's financial positions at a point of time by looking at the balance sheet and to see if Baidu is capable to pay off his current and long-term liabilities. We can see from the quick and current ratio to see how much current assets can cover any short-term liabilities that will become due in a year. So a quick ratio greater than 1 indicates that the company has more than enough quick assets to cover its short-term debt, and Baidu has 2.8 times quick assets to cover its current liabilities, which is okay. Ooh, matched quick ratio doesn't look very good. Its total debt to equity ratio as well as its long-term debt and total capital are reasonably okay as well. So I think so far we have done a pretty good job on the first step by examining the company's business model and by looking at its financial statements. And we can see the net income margin is good, although the net income goes up and down from time to time, but it's pretty normal for companies to have periodical larger operating expense to expand its business, which will take some time to generate additional revenue in the future. This needs a closer examination case by case. As long as it's not due to anything that shows its weakening competition power in the market, I wouldn't be so worried. And also it has a healthy debt level. I think we can be confident to say Baidu is a solid tech company with a lot of potentials to grow its revenue and earnings in the future. But a good company doesn't equal to a good investment. We have to value its current market price. How much is it lower than the intrinsic value? Does it have a sufficient margin of safety? Based on 34 analysts' estimate on Baidu's intrinsic value by using two-stage free cash flow to equity with the discount rate 8.5%, the perpetual growth rate 2%, Baidu's intrinsic value is about $390. With current stock price 164, that gives us about 58% margin of safety. I think we can say it's undervalued. But before investing, we have to talk about the risk in investing any stock, especially a Chinese ADR. Like many other Chinese ADRs, Baidu was formed in the Cayman Islands with VIE structure, and this structure has been around 2 decades. And fast forward to 2019, the final version of the foreign investment law has no provisions in regards to VIE. So which means that the VIE structure in under Chinese law is still in the gray area. It's not permitted or prohibited. I think for VIE structure, we can temporarily forget about the voting right that the shareholders doesn't have, because I think the biggest risk here is the Chinese government may enforce the regulation and ban the VIE structure completely. But the Chinese government does know if they do, there will be trillions of dollars wiped out from the international shareholders, and most of the capital is held by the institutions. And I don't think they're dumb, and I think that they know this nuclear option. Maybe that's why they're internally struggling to make a decision yet. Now let's talk about the delisting list. Early this year, SEC has threatened these companies to be audited by a US watchdog to make sure that they're not controlled by a government. Otherwise, they will be delisted. There are 248 ADRs that are listed on the US stock exchange and with combined market cap of $2 trillion. So is there any possibility that these companies will be delisted? Of course, there's always a possibility. And it's very similar to Chinese government banning the VIE structure because the process will be really messy. So for companies that they may buy out the shares from the public investors at a bargain, and they may go private or may relist it in Asia and make tons of money. And for institutional investors, that they will be able to convert the ADRs shares to the Hong Kong ordinary shares because of their volume. But for retail investors, that we may be stuck in the middle because we may not be able to convert our limited shares to the Hong Kong ordinary shares. And this happened before when the China Mobile was delisted from the New York Stock Exchange. And of course, the ADR supplies like investment banks and depository banks and the lawyers and accounting firms, they will do anything that they can to stop this, because if that happens, they will lose a big portion of their business. Of course, the last risk is the regulatory risks from the Chinese government. For Baidu's case, of course, it needs to comply with the antitrust and personal information protection law. I did a video before that you can check it out, and why China is cracking down its own tech companies. No matter how much I say about Baidu, if I'm bullish or bearish, and there are risks in investing in Chinese tech companies like Baidu. And for retail investors, if you really want to invest in Chinese companies like Baidu or Alibaba or Jingdong.com or Tencent, it's actually not a bad idea to invest in a China-focused mutual fund or ETF, because the fund manager can easily shift the ADR shares to the Hong Kong ordinary shares, or they already have. So how do you think of the Baidu stock, and what's the Baidu position in your portfolio? Please leave a comment below. My name is Irene. I hope you enjoyed watching this video, and I see you guys next week. Bye.